Welcome back, everybody, to Future Proofing You Book Club. This is on chapter 13, titled Using Mergers and Acquisitions for Future Proofing You. So the quote of this chapter is, "You've got to know when to hold 'em, know when to fold 'em, know when to walk away, and know when to run." This was from The Gambler, lyrics by Don Schultz. So this chapter in general, I just found very interesting. And again, mergers and acquisitions, right? But it talks about gives many examples of those who missed an opportunity or those who rejected the opportunity and went on to win even more. So the story of this chapter is about Eric Baker. Eric Baker was a co-founder of StubHub, which is the largest secondary market for event tickets, selling tens of millions of tickets per year. However, Baker was fired from his own company. So he was angry, flies to London, and launches a similar service, Viagogo. Viagogo is an instant success and grows quickly. Meanwhile, so throughout all this, that same board who fired him sells StubHub to eBay for $310 million. So Eric was rich, but at the same time was very unhappy. So Baker continues to grow his European event ticketing business, and on November 27th, 2019, exacts the revenge every fired founder dreams about. Viagogo acquires StubHub from eBay for $4.05 billion. He says, "It's personally satisfying to have my two babies together and be able to reunite them," Baker said in announcing the deal. However, this wasn't the best deal because the COVID-19 pandemic hit and just shattered all theaters and stadiums across the globe. And so Noah Kirch wrote in Forbes, "It's rare that you can judge a deal within months of completion, but the verdict on this one is absolute. Baker's purchase of StubHub will go down as one of the worst deals in history." Was it his fault though? Not necessarily. I mean, COVID-19 took everybody. That was just hit us, and we just woke up one day wow, right? But imagine if COVID-19 wouldn't have happened. It would have been a great deal. Mark Zuckerberg turning down a $1 billion buyout from Yahoo later went on to make billions more. Yahoo foolishly turned down $44.6 billion from Microsoft, an offer from Microsoft. That is $44.6 billion. That's a lot. How do you? And Groupon turned down $6 billion from Google, and it's now worth $500 million. So it just kind of goes to show you some are great and some are bad, but you have to know when is the time to either let go or to hold on. Now, this book talks about the art of the exit, why large companies acquire small companies, and getting an offer. And the art of exiting. In the 4 decades since Arthur founded his startups, he had been on both sides, and he learned one lesson. This lesson was, "I wish I hadn't learned my lesson the hard way. When I was in my early 30s, just a few months after my startup released its first video game, a more established company offered a third of its stock for acquiring my startup. Not wanting to lose control of my baby, I turned down the offer. Today, Activision Blizzard, the company that offered us a 33% stake, is now worth $61 billion. Now, if you remember in the last videos, I talk about instead of just taking a full lump sum, look for another opportunity to get more out of more, right? Don't just get one pen. Try to find a way to get paid by acquiring this pen. This one, a 33% stake. Now, it wasn't a lump sum, it was stock, right? And that would have been worth $61 billion. And then we see of those that don't go out of business, 97% are acquired, and so forth. Now it goes into why large companies acquire small companies. Well, to fully understand the acquisition process, it is important to comprehend the motivation of a public company CEO. CEOs make obscene amounts of money. In reality, most have a modest base salary and a huge upside for making their company more profitable and their company stock more valuable. So they're mainly focused on finding the next startup that could help them continue for the long term. CEOs have many other reasons for buying startups. Defensively, they may buy a startup to prevent a competitor from getting into their space. Another thing is, since the unfortunate experience, ask every startup before they launch their company. So what had happened was, he was part of a board of this company that was offered $100 million. They didn't want to take it, but the arts kept saying, just take it, just take it, just take it. They didn't listen, so he resigned, and then that company went. Anyways, that's why it says, since that unfortunate experience, I ask every startup founder before they launch their company, what amount of money would it cost to buy your idea today? The purpose of this question is to get people thinking about how much money they really want or need before crazy dollar amounts get blogged about online. Selling starts on day one and is a leadership-only function. Work out who will be your buyer, suggests former CEO Chris Gilbert, who sold his company to Cisco for more than $300 million. Only the CEO can do this. Constantly articulate why a company should buy you. And then now, getting an offer. Before you share any diligence material, you need to protect yourself and your company. Unscrupulous pretend acquirers may be looking to steal your customers or key employees, re-engineer your source code, or understand your cost structure. Always require any suitor to sign a non-disclosure agreement. If violated later, that agreement will be enabled in court in case for any damages. You may know more about your company than anyone alive, but your business is not mergers and acquisitions. You will need legal and tax advice. The earlier you bring in the experts, the more control you will have over the process. The acquirer's team sheet may seem straightforward, but unless you have been in this process multiple times, you may not know what isn't in the term sheets that could protect you. If your acquisition price is more than $100 million, you may want to consider hiring an investment banker. This is important. Why? Though expensive, often they take 1.1 or 2% of the overall deal. Investment bankers know how to structure deals better than most attorneys because that is all they do. When the U.S. Department of Justice Antitrust Division blocked AT&T's purchase of T-Mobile, T-Mobile received a $6 billion breakup fee that its banker had included in the deal. Not bad profit for a failed acquisition. So that was just the investment banker. But be as transparent as possible. Right from your first conversation to every piece of documentation, be absolutely clear and transparent with the business you are selling. Nicole Munoz, founder of Nicole Munoz Consulting Incorporated, says, it can be as difficult to purchase as it is to sell, but having a clear and transparent process is key. Many potential suitors may not want word to get out about the possible deal, but that doesn't mean you should keep it a secret from company management or major investors. Secrecy builds distrust, starts internal rumors, and causes unhealthy office politics. In order to shepherd an acquisition through, a founder needs to build consensus for the deal. The last thing you need is a potential deal getting scolded because of a shareholder lawsuit. And to give an example about what happened to Travelscape founders. Everything was going so good until the night before the deal, the acquirer tells them that the market conditions are changing, so they got spooked. Their board got spooked, and they lowered the agreed upon price by millions. Turner Media's purchase of Bleacher Report for $200 million was an 8-month journey. It went from something that seemed out of reach to something that really wasn't remotely possible, to something that might happen, to something we thought would probably happen, to something that seemed almost certain. You go to bed every night thinking there's a good chance this deal is going to go through, and knowing at any minute it could come apart for the smallest, most abrupt of reasons. The easiest acquisition to complete is when a telephone rings. By staying in dialogue with key industry leaders, promoting your company's accomplishments in the press, and making yourself accessible, inbound offers will come. If you have already thought through what you really want and have your house in order, the process should be quick and painless. The experiment of Vin, with the month to spare, Vin had achieved his goal by earning $1,033,802. Far from coasting across the finish line on month 11, much to his surprise, the revenue came from affiliate sales and so forth. Month 11. Anyways, that was all the chapter was about, right? Acquisitions and mergers, what to look for, who to go to, why to go to these people, and how this process is. It could be quick, it could be long, and it could be frustrating, it could fall apart. But as a startup, that's another thing to think about. If your company is extremely successful and someone wants to buy you out, is it the right thing or is it the wrong thing? Majority of the time, I don't know. So I'm not gonna say what it should be. Anyways, that is another question to ask yourself. But again, as the previous videos that I've said, and learning from this book, when you're being bought out from another company, just remember what you should take. Whether it's a lump sum, whether it's a equity stake, whether it's stocks. But before you're bought out, keep in mind what you want to be purchased for and how you're going to be purchased for, and whether you should be purchased or not. But that was pretty much the chapter. And this is very something I didn't know and something I learned from this book. The next chapter is chapter 14, fulfilling the need for profitable sustainability. That'll be the next video, but we're almost done. 14 and 15, that's it. 2 more chapters and then that's the next book. But thank you for watching this video. Buy your book. There's a link in the description below if you haven't bought your book and you want to go back to the beginning and read it all again. But that's it. Thank you for watching this video.